Let's talk about inflation. Zuber, you talked about it. Interesting article that actually came out yesterday from Bloomberg. We are experiencing quite a bit of inflation. In fact, I think a 40-year high, according to this article that came out yesterday on Bloomberg. Interesting facts. Wages and real estate are absolutely correlated. And over the last 100 years, not only has it kept up with inflation, but real estate has actually surpassed it by 2 to 3%, according to Colin Lazeri, who's an economist and professor at the University of Cambridge. So what are some of your thoughts, Tom or Zuber, around the hedge and the protection that real estate can provide against inflation?
I think it's probably the ultimate gauge. And I didn't do 100 years of research, but something I did about 6 or 9 months ago is I created a 50-year spreadsheet, which goes back all the way to 1970. Because I was afraid even 9 months ago that we were going to enter an inflation period. And the normal thinking is, and correct me, guys, tell me if you've heard this before. If interest rates go up 1%, real estate crashes 10%. How many of you have heard that? Have you heard that kind of rule of thumb?
I haven't heard it per se. I've heard something like it in the stock market, but yeah.
Yeah. There's a lot of talking heads that say, hey, if rates go up 1%, real estate falls 10%. And they always point at the '08 crash as kind of their logic. So I don't like rules of thumb. Generally speaking, I'm a data guy. So I said, all right, let's go back to 1970. Why 1970? That was the last time we had real inflation, right? North of 2%. So I did. I went all the way back to 1970. And let me just ask these questions. So first and foremost, in the 1970s, rates went up 300 basis points. 300, not 30, 300. So normally speaking, that's supposed to crash real estate 30%. Because again, it's unaffordable, right? Rates went up. Okay, great. What else happened? Well, first and foremost, real estate doubled. That's not supposed to happen. It's not supposed to happen. Why did it happen? Wages. And you hit it. Wages. So many people talk about real estate today like, oh my God, the price is higher today than 06 or 07. Pick your year. Those people are uninformed and are idiots. Next, they go, oh, it's price and payment. Because again, interest rates, right? We have rates going up and we have values going up, albeit slower, but still going up. It's none of those two things. It's the combination of price, rate, and wages. Wages nearly doubled. And yes, wages, I think, went up 87% from memory. Real estate went up 103%, even though rates went up 300 basis points. Nothing else did well. S&P 500 went up 1 point in a decade. Real estate did okay.
That's phenomenal information.
Yeah. Inflation. I mean, I think everyone knows owning assets during inflationary periods is a good thing, right? And, a lot of people got rich.
And the cash flowing assets are even better.
Oh man, phenomenal, right? So long as you're recycling that cash, not keeping it in the bank. But yeah, there's a lot of money right now being made from those who owned assets. And I think that will be the case for the next, 7 to 8 years. Yeah,
I mean, just go back and look at it. I mean, Google is a wonderful machine if people would take the time to use it. Go look at the S&P 500 from, I think it was 73 to 82. It went up a point. It actually might have went down a point. I forget if it was up 1 or down 1. That's a decade of dead money. Yeah, sure, you could be a stock picker and do all that stuff. I'd much rather be freaking lazy, right?
Yeah.
My real estate doubled. And oh, by the way, then we had 40 years of declining rates. To Mitch's point, I can go back and refi and get a better payment. And my rent's doubled. I mean, it's just
the Sharpe ratio. I mean, just look at yesterday. What a crazy market, right? Like
down 1,100, up 100.
Yeah, real estate doesn't shift like that. You have 6 to 12 months before you see some substantial.
And I want to hit that hard because again, I wrote about it in my book. Right, I survived the crash because I looked at my market every day. I was trying to buy my 9th house. It was unaffordable. It would produce negative cash flow. So I looked around and I found small commercial units that cash flowed like crazy because they were underappreciated. So I 1031 8 houses into 80 units and was fine. Yes, my net worth went down, but I don't spend my net worth. My cash flow went up because what people don't realize is the single family housing market fell 70%. 5% in my market, rents went up. Rents went up. So
here's the other thing too, that a lot of folks do not think about. You look at the cost of materials to build homes. Okay. Naturally they go up. This is why stocks have been a great inflationary hedge as well. Well, naturally, do you think corporations are going to eat that spread between the cost of goods to produce and what it ultimately is going to be on the market for, whatever the product is?
no, I mean, look at Chipotle. Chipotle gave us the answer. I think it was 14 months ago. They were celebrated for raising minimum wage. I think it was to $15 early in this cycle. They were celebrated. A week later, or maybe it was 10 days later, the price of my burrito bowl went up 9%. That's what's going to happen. They'll eat margin for a little bit. No.
You know,
I've heard of this new thing called skimpflation. Sorry
Yes.
to interrupt. Have you heard of this?
Of course, yeah.
I might have said this before, but I finally realized it when my dog food, and I'm going to create a new benchmark. It's going to be the price of dog food, but they cut, essentially I'm paying 20% more. A few months ago, they lowered it by 10% by the amount of actual food and went from 33 pounds to 30 pounds. And then last week I got a notice that it's going up 10% in price. So effectively a 20% reduction without fully feeling it, but I'm feeling it.
No, yeah. Inflation is real. And again, this is a numbers channel, right? So something I did the other day, because I'm so annoyed by the CPI calculation, which says rents up 3.2% or whatever it was in their last reading. So I went back and did the hard math, right? And the actual rent, so rent or cost equivalent or whatever you want to call it, or owner's equivalent, I think they call it owner's equivalent rent, is like 23% of CPI. It's the biggest individual component. They counted at 3.2%. The actual number is somewhere between 16 and 18.9. I took the lowest of the range, which was 16, did all the math, and CPI, the actual reading, just with the correction for rent, is 10.2%. You have fixed rate debt, 30-year debt. It's actually, Mitch, why I spent the last year or so refining all of my apartments into 30-year debt via a non-QM lender, because I don't want to have any interest rate risk in 3, 4, 5 years. So yeah, in real estate, it moves slow enough where if you're observant, you can pivot and change. The stock market can't do it. Crypto can't do it.
Yeah.
So I'm lazy and would much rather focus on a slower moving asset.
Well played,
I will say just,
Zuber.
I once heard this team out of Houston. They currently have like 24 projects in development. They're one of the biggest builders in Austin. Anyways, I was sitting down with them talking about a deal, and the guy says to me, he's like, it's not a bad deal, but I think about return on headaches. And it's like, it's kind of brilliant, because once you hit a certain amount of wealth, it's less about money and more about time and headaches. And when you think about the stock market, it is, so many headaches. To real estate, my headaches have been here and there for sure, and they can be a pain in the butt. But generally, I have far more headaches with the stock market than I do with real estate. So a metric that no one might be thinking about, but one that I think about quite a bit.
Well, I'm going to steal that. Return on headaches. That's
Yeah.
a good one.
Isn't that great?
I love that.
Yeah, me too.